Oh, yes, that's fine.
Cool. All right. Good morning, everyone. Great to have you all on the line. I'm really pleased to introduce Tobias Hestler, CFO of Haleon, who's with us today to run through our questions, as well as those submitted in advance by some of you on the line. So we've got about 50 minutes, so I suggest we just dive right in. Tobias, thank you for joining us. If we can start with the outlook for top line at group level before delving down into some of the categories. Your midterm sales growth target of 4 to 6% implies outperformance versus your expectations for growth of the consumer healthcare market of around 3 to 4%. And the midpoint of that range suggests market shares expected to grow by around 50 basis points or so over the next few years. Can you sort of help us understand whether this outperformance is expected to come more from share gains in existing markets, or is new market entry a bigger element of that?
Yeah, sure. Thanks, Victoria, and good morning, everyone. So thanks for joining, and also thanks for the questions you pre-submitted. So I look forward to the dialogue, and thanks for your interest in us and in Haleon. So Victoria, on your first question, so the midterm sales growth target, I think it's, first of all, it's both, right? I mean, it is gaining share from others, but it's also penetration opportunities and new market entries, where that means we grow the category. And I think we've done that consistently over a very long period of time, especially in oral health, where we have been the driver of category growth with our rollout of Sensodyne and our denture care business. So, but there's also, I think, still, huge penetration opportunities, and penetration opportunities means you gain share from others, which means you bring people into our subcategories that we play in. And oral health is probably a good example. So when you look at Sensodyne, and with the latest data we've done last year, we think about 45% of the world's population are either aware they have sensitivity, or they suffer from sort of frequent, what they would call twinges. So 6 or more months when you eat something, so there's something happening in your teeth. So what we call them is a sensitivity receptive audience, right? I think sort of people that have a bodily need, that something aches, hurts, where you say something isn't right as it should be. Yeah. And by the way, that figure is pretty uniform around the globe. There is no difference in population or lifestyle or anything, right? So it's a global topic. And then, so about 45% of people have that. When you look at Sensodyne penetration, it sits around 15% in the US, slightly higher than in the UK, and lower than in other markets. So there's a huge penetration opportunity of people saying, I use a sensitivity toothpaste. And the good news in this isn't a new product you need to add to your shopping basket. All you need to do, in big quotation marks, is you need to change your toothpaste brand and keep using a different toothpaste. Yeah. So it's not something where you have to educate and say there's a new product on a different shelf that you have to pick up. So that is one example. Another big example, I think, is gum health. So about 1 in 2 adults experience bleeding gum and gum disease as part of the life. Again, that incidence is pretty much there globally. And with Parodontax, we have a brand that we haven't really launched elsewhere. So there's huge penetration opportunities in that brand. Centrum, another example, is only in a third of our EMEA LATAM region market. So there is geographic expansion opportunities by bringing that brand into new markets. Yeah. And then you probably also have maybe 2 other angles why I think why we're really confident about the 4 to 6% growth, which is one, further growth in e-commerce. It's now 9% of our business. 4 years ago, it was 4%. So there is a channel mix, and we tend to have higher shares in e-com than online. So I think that helps. So that's a growth driver. And then I think the emerging market mix, a third of our business, 33% last year, is emerging markets. That emerging market footprint is pretty broad, and emerging markets have grown high single-digit, double-digit historically. Last year they did 16%. So we're doing well in them, and that also helps sort of in the growth mix. So when you bring all of that together, I think there is the portfolio from a category point of view, from a geography point of view, and also where the penetration opportunities are, provide these opportunities for growth.
Yeah, and I guess if we focus in on the emerging market opportunities, could the potential growth contribution outweigh that, you think, of developed markets? And I guess also specifically, do you see some of the potential hurdles to taking share in emerging markets breaking down as international science seems to be carrying increasingly more credibility in some of those markets?
So look, I mean, I think clearly from a percent growth perspective, it's been outweighing the developed market growth, right? Last year and in the prior year, so absolutely. But then you have, of course, the relative size of the two. These developed markets are much bigger, so I don't need to grow them at that rate of growth to add the £1 million of growth that we need, right? But I think we absolutely, I would say, clearly emerging markets growing ahead of the developed market. Also means just given the portfolio they have and so on, as I said before, right? Not all the brands are in all the emerging markets, so you should get more growth from them. And I think it's look, I think it's less to do, in my view, with acceptance of international science. I think it's a matter of, one, have we taken these products to the markets? Because I mean, clearly, as I explained with oral care, these are global incidences, right? Of course, how you enter the market is different. When you go to a market first with Sensodyne, you have to first educate that when it hurts and itches, then this is sensitivity, and here's what you can do about sensitivity. That is a very different activation to talk to consumers than the one we do in the US, where the product and people know what sensitivity is, or a lot of people know. So there's less of sort of the basic education, but you explain much more about the science and what's in it. Yeah. And then I think there is also in the emerging markets, I think, a growing size and share of people, and we call it the growing middle class or whatever, but there is a population that can absolutely afford and wants the best possible treatment for their health. I mean, example, we launched Centrum in India. We just did it on Amazon last year as a test, yeah. And we got a 10 share on Amazon and really strong demand, right? So I think there's markets that are sort of ripe and ready for different type of treatments that might have not been available so far. And I think given the portfolio we have, we believe strongly in those expansion opportunities.
Okay, great. If we sort of look back at this outperformance versus the consumer healthcare market historically,
Yeah.
this really stepped up through COVID, with the Haleon business as it is today reporting a CAGR of 4.4% from 2019 to 2021 versus the market, which we think was around 2 to 3% over the same period. And one thing we've seen from some of our other coverage companies is that there was an element of benefiting from having more flexible supply chain versus some of the smaller players throughout maybe this more difficult operational period. So just wondered, is that something that you think Haleon benefited from? And if so, have some of these smaller players started to come back on stream now that supply constraints seem to be easing?
Let me just unpick your statement into two parts, right? The first part you sort of said we stepped up and benefited through to COVID, right? And I think I see that a little bit different, right? Because I think what happened at the same time as COVID is you saw the benefits coming through from creating Haleon and bringing that Haleon portfolio together and doing the divestments, yeah? So I think the step up in growth comes from, in my view, the creation of the Haleon and the Haleon portfolio, both from a geography and from a category point of view. We now participated in VMS. We were now a number one in the US. We were 5+ there. We are now a number 2 in China, a number 1 multinational. So I think that, and then we divested 50 gross dilutive brands, which had about a drag of a percentage point on growth in the past when you look at prior GSK reported data. I also think we've consistently outgrown the market. The best example where you can really track it is oral care. We've outgrown the market in oral care 2 to 3x. So I think we've done that historically. It's not something new. Yeah? What happened in COVID is actually COVID for us was negative from a growth rate point of view because we took the big hit on respiratory because there was no respiratory business for about a year. I mean, it halved, right? And then we got a little bit of a tailwind because there was more VMS sales, but the net of that was negative. So we said about 50%, 50 bips drag throughout these 3 years, right? So I think that's just how I see this, right? So I believe we've been well in the 4 to 6 even through COVID. And it comes again, in my view, the strengths of the portfolio where things even each other out. Yeah. Your second part of the question on supply chain. So I think what we've seen happen in COVID is two things. One, we've seen through COVID, when a lot of people went shopping online, we saw actually a preference on brands, on brands that people knew and trusted, and you had so much stuff suddenly to do, you probably didn't have the time and looked for other stuff. So I think there was a benefit of, I think, big brands that people trusted, and I think we saw a bit of that. The other piece, I think, is supply chain. I think we've done well in it, right? Now, have we got it right everywhere? No, we didn't, right? I think this is just there was such huge spikes in demand happening that are unplannable and that you can't deal with. But I think the team has done a brilliant job in being as agile as we can. I mean, on Panadol, we slimmed down the range of SKUs, prioritized the important SKUs so we can be there on the shelf for the consumer and look, at least ensure that there is the one, instead of 10 SKUs, at least 2 are there on shelf. So I think there's a bit of that agility that was there. But I think overall, I think we've done well with certain exceptions here or there. Yeah.
Okay, cool. I guess maybe if we stay at the group level, but think more about the near term.
Yeah.
So it seems like absolute price levels were pretty stable sequentially in Q4 versus Q3, which we estimate at around 9 to 10% ahead of 2019 levels. And I guess during the results presentation, you called out the need to carefully manage pricing versus volume growth. So how much pricing is still to go to recover cost increases? And should we see that statement as suggesting prices still need to step up substantially again in 2023? Or does it suggest that you may not actually fully price through? And I guess if the former interpretation is closer to reality, should we see this as providing confidence in the 4 to 6% targeted sales growth for this year, despite cycling some difficult comparisons?
Yeah. So look, I think in short, it's the latter, what you described, Victoria, right? And I think let me give you just a bit more color on it. So I think first of all, I mean Q3 and Q4, you saw a similar level of price increase in percent versus prior year. That doesn't mean pricing was stable. It meant because in Q4 the prior year we increased prices on half the US portfolio. So in order to still do 5 on top of the spike from last year, from the prior year, it meant prices actually went up, right? So the prices on shelf. So there is continued pricing, and we're also taking continued pricing this year. And the reason for that is twofold. One, yes, inflationary material headwinds have started to peak, and on certain materials we're starting it to come down. But it's going to be another 6, 9 months or 12 until I see that rolling through my P&L, because we had fixed price contracts that roll off. So I'm rolling over to a new price level. So that's one. Of course, that isn't as big as it was from 21 to 22, where I think we said, it was well in the mid-teens, that inflation. I think that comes down now to mid to high, but that means we still have to take price to offset that. Yeah? And I think the team last year has done a really good job in offsetting these price increases. What's always a little bit more difficult to us is to offset it at the percent gross margin level, right? Because I think in a business in OTC where you have margins that are 65-70% plus, if you have a pound in material cost increases, in order to maintain the margin, you need to increase the price 3 to 4x, which is massive, right? So I think but I think we've offset it off nicely. And then the other thing is, we've been very, very mindful in pricing, because when you look back last year, we grew volume and we grew price. So we didn't have this double-digit price increase, high single-digit volume decline, because what we feel is the best thing we can do for the business long term is keeping people on our products. It's products you trust, you stick with them, and you keep using them. So I think what we tried is to find this price point that we're not losing the consumers along the way. And I think the team has done in aggregate a really good job in doing that. Yeah? And then maybe my last point on pricing is, I think what we're talking here is a difficulty and is hard to manage and finding the right pricing level is a Western European US topic predominantly. Asia, very much lower inflation rates, so much less of an issue there. Across all of our emerging markets, I would call it business as usual. You always had an environment where the market needed to price up, be it for inflation rates or because of exchange rate hits they took or the local economy. So I think that is for me business as usual. So when you take that together, you're well in the 40s range of the business, where it's, I think, either not new or not different than it was in the past. So we're down to Western Europe and the US where this needs to be managed. Yeah.
Okay, very clear. Thank you. If we turn maybe to sort of down trading or private label risks, you called out some signs of down trading with the results last month, albeit still pretty limited. Are the areas that you've seen so far where you would have expected the consumer to perhaps crack first? And what are the categories or geographies within the portfolio that you would see as most at risk if the macro were to materially worsen from here?
So look, I must actually say the data we saw and we shared at full year result is even better than I thought, right? Because private label share in the US is the exactly same number as it was the prior year. So we've not seen people move to private label, yeah? Now what we said is there's one or the other subcategories where that happened. Let me give you an example. Anti-acid, so proton pump inhibitors in the US, biggest brand for us, they're Nexium. What we've done there is that's one example where we didn't get the pricing right. So we're a leader in the category. We led with price. Nobody else followed, and private label didn't follow. So actually people went to private label and sometimes to competition. So that's one that the team is correcting now. We've taken this sort of price, volume, finding the right line between them a little step too far. Team did the right job, but that's one where you correct back. And then you have smokers' health, where people took a bit more. This is anyway a category that goes up and down. So we're not seeing actually any signs of the consumer cracking. And look, in the US, you have fantastic data. You can you can get data cut by income level, which we've done. And also there we don't see that. And so I'm not worried about private label because I think that when you look at what our products are, so our products are in healthcare, they're not in your daily and weekly shopping basket and rarely in your monthly shopping basket. So your purchasing occasions are less frequent. When you're sick, you tend to go back to what you trust. Yeah. And look, I mean, for me, if I get a cold and flu, I use what my mom gave me, right? Or if your partner sends you to the pharmacy because your child is sick, you're probably not gonna bring a private label home unless you have used it before because you've been told that's the brand and the child is sick, so you better bring this home. And probably also when you think about the last time you bought a cold and flu product or an allergy product, you don't remember what you bought it because you buy it once a year. If your kids in kindergarten, respiratory maybe a bit more often, right? Or if you have a heavy allergy suffer. So I think the brands we have and what they do and you treating your health, I think in our view, much less exposed to private label. And that's, by the way, also the reason why private label shares have been pretty much flat over the past, probably in the US, we have data for the last 2 decades, and it's been that, right? Yeah.
Okay, cool. If we sort of look through maybe a category lens now,
Sure.
starting with oral care, which is about 30% of sales. Sensodyne is obviously already a mega brand with sales of around 1.5 billion. And obviously Parodontax, which we spoke about earlier, still has large expansion opportunity. So can you give us an update on the relative size of Parodontax and its sort of launches today, and maybe how ambitious that launch plan looks in the near to medium term? Is that sort of something that's been able to be accelerated post the separation from GSK?
Yeah, look, I mean, I think, Parodontax is a significantly smaller brand than Sensodyne is, right? And I think I would say we've probably activated it properly in maybe a dozen markets in the world, yeah. But I mean, as I said earlier, gum disease is a global phenomenon, so I think that's where the opportunity is. The second piece is that the way we launch our products, this isn't usually one where you enter a market and you do a year and a half or 2 year of big consumer advertising. You do consumer advertising along the way, but how we're building our brands is building support by the experts. And for us, the experts are dentists and dental practitioners, educating them about the product. So when you're in the dentist chair because you get your hygiene or in front of the dentist, that they recommend you and say, hey, look, with your gums, I recommend you using as either a sensitivity or a gum toothpaste, and I would recommend you use Parodontax, yeah? If you stay with the Parodontax example. They usually hand you a sample, and then you start using it. And then when you start using the product, you've got to see improvements over quite a fast period of time. And then when you're ready to buy, that's when I think then we're there. So then you can buy it then in all the channels. And that tends to be a slower build, right? I think it's very rare that you go into a market and it's taking off like a rocket. These are slow builds. But I think the benefit when you do it that way is that and you ask, Sensodyne users today, I mean, over 70% of will tell you, I've started using it because my dentist or my dental hygienist or so recommended me doing that. Yeah? And a similar thing we have is the pharmacies where we sell stuff to pharmacists. It's a pharmacist, again, a healthcare professional that recommended you to use the product. Yeah, and I think that's where there's potential. And look, I think yes, absolutely, the Parodontax is one of those investment opportunities where we invest and we double down on investment. Yeah.
It is, I guess, sort of touching on what you just said, but
Yeah.
is Parodontax by its nature more of a referred product because you kind of have to be told you've got gum disease relative to sensitivity, which is something that's perhaps more self-diagnosed? And I guess, does that mean it can command a higher price tag because of that recommendation element? And I guess from what we've been able to see online, it tends to retail at a higher average price than Sensodyne.
Look, I think it probably depends where you go, but I mean it's a therapeutic product, right? And for us also, Sensodyne is a therapeutic product, and we've launched it at a very, very high price point for that reason, because it is treatment, right? And it solves a healthcare need. I think gum disease, I mean, mostly it's associates with bleeding gums, and I mean you see when you brush and it bleeds. So I think the work we have to do is we have to educate, right? And our consumer education on it is, I think, here is the signs that you can self-diagnose. I mean, the blood is, I think, very obvious, but then there's also other signs. I mean, usually if you have it, it tends to come along with bad breath. It comes to have along with you see your gum lines receding. So I think there's education to be done that we do in our direct consumer communication to talk and educate about the issue and the topic. And then you buddy that up and couple it with the recommendation from the healthcare professionals. I think that's been that's how we go about that.
And I guess also just thinking about the learnings from Sensodyne and sort of that education process, did it suddenly get to a point where that critical mass or education or awareness suddenly just avalanched? And is that something that actually could, over a couple of years, happen with Parodontax as well?
What I have seen, I think this has been more of a steady build, right? I don't think you reach a point when it's taking off. I think this is a steady build of getting people to try the product, see that it works, and then they continue using it. And then what we've done on Sensodyne is that once you're on Sensodyne, you start sort of with the base Sensodyne that just treats sensitivity, which for some people might be enough. But then the next time you come and repurchase it, or whenever in your life, your needs change, right? That you say, you're, I don't know, you drink a lot of tea, then whitening might be a combination. Then you do Sensodyne plus whitening so that your additional need is covered. Or it's speed of action that you say, look, I I'm a heavy sufferer. I really want to be sure it works. So I brush my teeth before I go and eat an ice cream. So then that's when we brought out Sensodyne Rapid. And then there's enamel repair. So there's these additional needs that you pick up along the way that to keep the product relevant and fresh for you as a consumer. So in addition to making sure the base product is and continues to be the best sensitivity treatment in the world, it is then keeping you on the journey that that we provide this incremental need. But it's also sensitivity first plus your other need that you have. Yeah.
Cool. If we move on to VMS, 16% of sales, there's a lot of debate going on with investors about volatility on performance and the fundamentals of the category. So firstly, through COVID, could you just help us understand what proportion of the portfolio was exposed to COVID-triggered adoption that's now normalizing versus the less impacted parts?
Yeah, so let me maybe describe what happened with the overall category, and then I talk about our products. So in the overall VMS category, we saw a bump with the category growing in the low teens in the COVID year. And then it's grown steadily from that base. Yeah? So what we haven't seen, and we in the subcategories that we play in, we've not seen people come running into the category and then dropping off, right? I mean, so it was a big step up, and then we thought maybe the following year it's gonna drop. It didn't, and also we're not seeing it this year, right? So I think and I think in our view, it has to do with, I think COVID reminded all of us is how important it is to take care of our health, and I think that carries along, right? And I think it's sort of one of those basic needs that's moved up in the ladder of how we take care of ourselves, our families, and how we lead our lives. Yeah? Now, when you look at our portfolio, there's parts of portfolio that aren't impacted from COVID, like a Caltrate in China. Treats calcium deficiency, a basic healthcare need that is independent of COVID. And I think the team is our largest brand in China. The team has done a brilliant job. It's supported by the Chinese government as part of their Health 2030 agenda, helping people to treat deficiencies, which is pretty much a Chinese phenomenon, or across some of the markets in Asia. So I think that part of the portfolio isn't impacted by COVID. And then I think the overall multivitamins were pretty stable. There's some people that came into it, and that's also. And then we had one brand that really went through the COVID roller coaster, which is Emergency in the US, which is a high dose vitamin C in an effervescent powder. With some cool flavors in it, has an immunity claim on it. So I think that did each time the papers and newspapers were full of COVID, and then I think you got these crazy spikes, and we're still going through them. And when you look at my presentation I did at full year, we sort of showed that a little bit where you see those little spikes, and we're still working through those. Yeah.
I think if we could just focus specifically on Caltrate quickly, the supplement brand for for calcium. We've seen a proposal from the government in China considering mandating mass nutritional fortification of various staple foods in order to sort of combat those nutrient deficiencies, which could include calcium. So how much could that be a risk for the brand, and what can Haleon do to retain consumers if the prevalence of calcium deficiency recedes?
So look, I mean, I think it's a phenomena that it's there, and it's been there a long time. And what the government has done in the past is they've given out calcium treatments for free on sort of in the hospital, right? So you could get it sort of under prescription and then be paid for. And the government has massively pulled back on that to get people to do self-care. And so I think there is enormous growth potential in there, because the amount of people that take calcium supplements is still quite low, and that's, I think, a reason why the government's looking what other tools we have available. So I think there is enough growth potential. Secondly, I think what we're doing is we've built Calcium Plus Plus, so that we move from a calcium treatment to a calcium plus other needs you have, a calcium plus a probiotic, a calcium plus And then the third piece is we're also moving with Centrum into, with Caltrate into different forms. So we did a Caltrate plus milk in a gummy form that is much more suitable to give to younger people and to kids. So you can start treating that earlier, and there's we believe a high enough population base that is interested in that.
Cool. If we just quickly cover off respiratory, 22 saw a big increase in cold and flu incidents in a prolonged season, driven in part by COVID, which resulted in sales 30% of 2019 levels. In the near term, there's quite a lot of debate with investors as to whether the 4 to 6% organic sales growth guide for 23 assumes a decline versus last year to more normalized levels. Is that something that you can shed more light on for us at all, please? And then can we sort of clarify what we think you said at the full year results, which is that you don't see any excess retailer inventories in the category currently?
Yeah, so let me maybe unpick what happened last year a bit, right? Because I think there is the first half last year and then maybe Q4. So the first half last year was a comeback from what we all hope was a once in a century event with COVID and all of us being locked home and the kids and not going to be able to go to kindergarten. So that wiped out cold and flu. And what happened in the first half last year is it came back. So the around 50% growth we had in that category last year is from a comeback, right? It is not because it was a super strong season, right? So, and then what happened in the second half of the year is yeah, there was more use of cold and flu products because the COVID variants that have been going around, they're still going around, also have cold and flu-like symptoms. So people use those products. That has continued to date. And then thirdly, we had last year a bit of an earlier spike, especially in the US, where the season just started a bit earlier, which is sort of the normal stuff around. One year it starts in November, the next year it starts in January. You don't know what kind of season you get, and if you get one spike or no spike, or you get sort of the bumper season, which is a triple crown where it happens 3 times. So I think, and that part is, yes, it might make the results a little bit more up and down year to year, but we always said that. And that's also why we report this respiratory category separately. Yeah. Now on inventory management, this is something the team is doing very, very diligently because we have it every year. What we do is we sell into the market and we fill up pharmacists and retailers' inventories in usually Q3 by the end of Q3. The reason we do this is when you have those spikes, and you saw it on the charts we have, you get a whatever quadruple the weekly sellout, quintuple within days. There is no time to repipe the market in that time. So you need to have the products as close as possible to consumers for these spikes happening. Which then means is we're tracking the season, we're tracking these inventory levels, and make sure by the end of the season, March, April, when sort of the spring flu thing is over, that we're down to normal inventory levels before you go into sort of the off-season months, because what you don't want to happen is that there's too high inventories by then. And that's what the team is doing. And look, I think we had earlier spikes in the US, which means the US ended the year with very, very healthy or probably too low levels. So I think, and that's also why, as a result, I mean, in aggregate, we have said we saw continued growth in respiratory going into Q1, right? And by the way, the chart I have shown where US. The dynamic in EMEA LATAM is slightly different. They didn't have this massive spike, and I think it continued. It continued out a bit. And look, we're going to take another month or two until we can sort of draw a line and then can make a conclusion on how good of a season it was. Yeah, and then let's see what happens this summer. That's the unknown. Will we still have endemic? Will we still have COVID strains going around, and those COVID strains also having cold and flu-like symptoms or not? That's the unknown, right? But that's sort of the out of season delta that you've also seen on the chart I put out. Yeah.
If we spend just a minute now to look at additional potential sources of growth further out, at the time of the demerger, you highlighted 2 potential RX to OTC switches in 25 and 26, which could each have the potential to add a percentage point to revenue growth on top of the 4 to 6%.
Yeah.
Are these switches still on track? We know you can't tell us precisely what they are, but can you share any more details on the cost link to those? And are there perhaps other alternatives that could be on the horizon if either of those are not successful? Or would that still be too far away from potential authorization and commercialization?
Yeah, good. So, I mean, absolutely. So first of all, I think, we had said we're working on 2 RX OTC switches. We continue to work on them. We're in discussions with the FDA. Based on these discussions, we think that there might be a delay, at least to one of them, I think, and that's pretty much normal. And that's also, and because all these switches that we're working on and also what our competitors are working on, at least the ones we're aware of, they all have complications and they aren't easy to do. So I think this is pretty much the normal nature of RX to OTC switches these days. I think the easy ones, in a lot of quotation marks, I think they're behind us. What is there on the horizon and to be had all has its complexities for very different reasons, product by product. That is also the reason why we said switches are outside our 4 to 6 guidance. Yeah, that's the icing on the cake when you get them, right? And I think if I look at my 5-year financial plan, do I expect a switch to happen in a 5-year plan? Yes, I do, but I couldn't tell you in which year it's going to happen. So you keep it as an opportunity outside of the plan. What we put in our plan is the full funding, so that the switch team, the R&D efforts, the studies you need to do are fully funded. Yeah. In addition to that, of course, our team is very, very active in scouting the market to add to that portfolio. So that so I think this what we would want is we would always want to have several switches that we work on, and then we'll talk more about it as we either see they're not progressing, or secondly, once we're getting to a point when they would become public anyway, which is usually around the time when you do a bigger, when you need to do a bigger trial and it becomes public because there's trial activity going on. Yeah, sometimes actually you might only hear it much closer to launch, and that's of course what we prefer, because you don't want to put any of your competitors onto what kind of categories or products you're working on. Yeah.
If we move on to the margin outlook, and specifically A&P spend, which was flat at constant exchange rates in 2022 versus 9% organic sales growth, and that was impacted by stopping spend in Russia in the second half, as well as efficiencies from moving production in-house. Just sort of excluding Russia, which we think was around a £30 million saving on a 4-year basis. Was this spend in line with expectations, or was there an element of spend held back due to timing of innovations? And also still related to that, will those production efficiencies continue into the first half? Or put another way, how should we think about the phasing of A&P spend through 23?
Yeah, so look, I mean, I think for me, the most important metric was last year, and also not last year, it's still the most important metric is how are we doing in our consumer and customer facing A&P? So are we putting more advertising mainly, and then promotion? We're much less promotion driven business, but mainly in front of the consumer. So I think that's where the measure is. And I think when you exclude Russia, that was up 6% last year. So I think we very well invested into the brands and into making sure our products are presented in the right way in front of the consumers. And then under that, of course, you switch and you shift stuff around. You took money out of China in Q2 because the country was in lockdown. And then you also, of course, you wouldn't then grow your A&P if you have a very strong cold and flu season, because the stuff is flying off the shelf anyway. So you wouldn't increase it and as much. Yeah. We had a really good year with efficiencies last year. I think there was opportunities through sort of the inflation environment as well, because people pulled back, and other companies that really suffered what happened had to pull back. So we were able to get more media. We also, I think the team did a really good job bringing production in-house. So I think, and that those things, have a bit more of a stepwise function. You can't plan them to run continuously. What I would expect for 23 is that we're growing A&P ahead of the rate of sales growth. And then what Brian and our region heads are doing is we just continuously watch. I mean, we wouldn't throw money out of the window. We need to have the execution plans behind that. But that is clearly, I think, the model that we see going forward, right? And I think when you look at consumer-facing A&P, that's what happened last year with 6%, which I think is around the mark. And also last year, I mean, when you look at, there was incremental price increases that you also then probably wouldn't put the same amount of A&P behind those, right?
And then I guess if we look at efficiencies, a productivity program was announced at the full year results, which aims to deliver annualized gross cost saves of around 300 million a year over the next 3 years. Can you give a bit more color on where these savings or efforts will be focused, and sort of the conversion cost for Haleon relative to a number of our other coverage companies is closer to 20-25% of sales. So could we assume that there's more scope in manufacturing?
So let me maybe give you a bit to start with the efficiency program first. So I think the efficiency program is what I see as the evolution of our company that we always expected. When you look at what I presented at the Capital Markets Day a bit more than a year ago now already, is that I said from 2023 on, I would expect other SG&A to come down over time. And I think that was absolutely clear expectation that post separating out, that we can start driving efficiencies. And because when you look at how we separated, our separation approach was one that we went for stability. So we copied and cloned and as much as we could in terms of processes, all our systems are a copy of what GSK had. That had a huge benefit because it gave us stability. It allowed us to do all of external reporting. I mean, we published our result. Our annual report came out this week in the same timelines as other FTSEs that have been in the market for a long time. So now the price to pay for that is that these aren't systems and processes yet that probably aren't fit for a consumer type company. So and that's the evolution that we're getting into. And I think we had more time than after separation was done last year to look into that. And I think we're confident to be able to deliver 300 million. And we felt then we should announce it with our full year results. So I think it's an evolution and a journey becoming a more agile and faster organization and doing things in a more easier way, which comes at a natural time. Separate first, it's gone well. So now I think is the next phase that we're entering now. And I think I would predominantly see this in the other SG&A area. And then I think that gives us then, I think, the confidence and the ability to invest and reinvest in the business in a still, a difficult external environment. When you look at conversion costs or cost of goods, I think we've done the heavy lifting with the integrations of Pfizer, GSK, and Novartis. The three companies together had 41 manufacturing sites. We're down to 24 now. So I think we've done the major improvement steps on the efficiencies we can get from that. Now, I'm not saying there are no efficiencies. You can always do, but there isn't another chump change happening on that.
And just quickly, before we move on to strategy, can you give us an update on Russia and whether we're right in thinking that the company is recording sales but no profits from the country? And is organic growth still declining as the reduction in the portfolio is annualized?
So look, I think what we've done in Russia is we're still active in Russia, but we significantly streamlined our portfolio to healthcare products. We've done that in Q2 last year. We stopped advertising. So I think what we're doing is we're shipping to the demand that pharmacists have. So there's a demand for a pain product. We ship to that demand, and that's what we have continued to do. And I think it's ultimately when we believe that is the right thing to do, given the portfolio have and the role we have to play in terms of health for our employees. Yeah. And then I think we're not commenting on profits that we're making. What we have said publicly is that we're making donations. So humanitarian donations plus the support we give to our employees to deal with the crisis, both in Russia and the Ukraine and neighboring countries that are impacted by it. And we were making multi-million-dollar donations in addition to that for humanitarian causes, and we have done that, and we're continuing to do so.
If we sort of switch to our last topic of sort of strategy and sort of starting with channel exposure, one of the key arguments for the Unilever bid last year was based on potential supermarketification benefits from sort of rolling out consumer healthcare products into Unilever's distribution footprint. So we just sort of wondered whether you think that accessing new channels is something that could materially help Haleon scale up growth.
So, look, I think, first of all, when you look at over-the-counter medicines first, which I think last year was 54% of our revenue, in the vast majority of the world, you can't sell them in supermarkets. It's just not allowed. So go to continental Europe, you have to go through a pharmacy. France, Spain, Italy, many of the Asian markets, it's the same. So you need to sell it through a pharmacist, through a licensed pharmacist, or a different store that has the license to sell those. For then 60% of our bit. So the only difference where it's in the same channels is the UK, it's the US where it goes through big retailers, it's Australia, Canada. And in those markets, I mean, these big retailers, they buy shelf. So so actually there's a category buyer for the OTC shelf, and that has nothing to do with the buyer that buys the I don't know, cornflakes shelf, right? So I think and we have, with the scale now, I mean, we have a number one or two position in over 70% of the OTC VMS markets in the world, I think, and that gives us the seat at the table to be seen and to work with a Walmart as a strategic customers. And I wouldn't see any benefits from another big consumer group with those customers. Yeah. Now, where you could say there might be some opportunities is in emerging markets. Could you get it to more distribution points where you don't have these regulations? Yeah, but I think this is probably in the rounding of the portfolio. And I don't think this could be, you know, a strategic driver for a deal, because we have the critical mass. And I think for me, the question is always, and that's why I think the two M&A transactions that we did, so bringing back the three companies, Novartis, GSK, and Pfizer, on the consumer health side, made such a difference, because it fixed these gaps we had from a channel geography portfolio, that now we have these leading positions, and the leading positions then allow us to build the distribution and the go-to-market network to go and see those consumers, right? As we do on the over-the-counter business, where I think we have one of the world's largest pharmacy field forces, and we're seeing those pharmacists on a regular basis. Yeah.
Sort of thinking about that portfolio management aspect, we've seen press reports on a potential sale of chapstick in recent weeks, and sort of thinking on from that, just wondered how the growth of Smokers Health compares to the rest of the group, and whether it actually has limited supply chain efficiencies relative to some of the other products that you've got. And then on the other side of that, what would be the key categories, geographies targeted for development via bolt-ons, and how would you think about adding exposure to more volatile or seasonal elements like respiratory?
Yeah, look, I think, first of all, I mean, sort of as a matter of principle, we're not commenting or talking on any speculations there is in the market. So I think there will always be, so we just can't comment on that. But you just take a bigger step back from that. I think what you would expect us to do as a consumer company, excuse me, with a portfolio of 100 brands, that you would expect me to look at that portfolio of brands, both from a resource allocation point of view, which brands get the resources allocated, but also when you look at the more tail end of the brands, a regular check if those brands are we are still the right owner, and is it best to keep the portfolio there, or is there actually a better owner, right? And I think that's a duty I have as my team to say, oh, actually, there is a brand that we can't contribute and put the resources to it, is it actually better to divest it? And then you only find out when you start a divest process, you ask for bids, if that's actually the case. And the outcome of that might be, you might get a bid that it's actually better. And then you say, oh, it's actually better to divest and it's better for shareholders. Or no, it isn't, because the bids we got are significantly below the keep valuation. Then it's better to milk it and accept that you have something in your portfolio that might be a little bit growth dilutive, but the earnings and cash you make on it outweighs the potential you could have gotten. And look, we only divested one brand last year, a smaller one. That's not enough when you look at the size. So I think the healthy thing to do, and now we have the capacity again, given we divested, is that we look actively at our portfolio and do that. And I think that's the right thing to do for a company with our portfolio of brands. Yeah. Now looking at where we would go for M&A and add to the portfolio, I think the two dominant, predominant places that we're interested in is VMS, so vitamins, mineral supplements products. Given, as you said, is 16% of our revenue, can we make that a stronger third leg in our portfolio overall? And also, this is also the space where there's brands and products available. So when you look at M&A that was done in our categories, I mean, the vast majority of that is in that segment. There is very little coming to the market in OTC and other brands. So I think there's also, a function of demand and supply in the market. So I think, so clearly VMS. And then I think it would be, what we're also looking at, are there local carrier brands? Are there local brands that have a brand recognition as an over-the-counter or maybe as a prescription medicine that we could buy and then use that brand to and feed our global innovation pipeline into that, so that you can sell the brand based also already using a local brand recognition rather than introducing a new brand name into the market. Yeah. And of course, in addition to that, you have then RX to OTC switch, BD&L deals, and of course any business development licensing you would do on the R&D side. So that's probably the sort of priority things as you look at bolt-on M&A opportunities. Yeah.
And just in terms of larger scale M&A, is that a bit less attractive now that the key gaps have been mostly plugged already? And as you said, there's more limited availability of large assets. Basically, and you would be looking more for sort of these more local brands to slot in.
Yeah, look, I think there has been very little consolidation in the industry, right? And I think over the last 20 years, it is not an industry that has consolidated much, and the synergies have existed 20 years ago, right? So I think, and synergies alone aren't the reason to do the deal. And I think and you mentioned it, Victoria, right? I think the beauty of the two consolidation steps we did is it fixed strategic issues we had, both from a category and from a geography point of view. And I think it made us a stronger company at the other end. And I think that's sort of first and foremost the lens to look at any potential M&A. And then you have to add if it actually comes up, right? Because I think there's another thing, that these OTC businesses or VMS businesses have stable cash flows and margins. So there's quite a hurdle for someone to actually being ready to let go of them as well. And which is another reason why there wasn't that many assets coming to the market over the last, 10 and 20 years since I've been in this industry. So I think from that point of view, look, we'll see what happens. It's all highly speculative. I think our focus is on the bolt-on M&A side. And of course, if something else comes up, we're a market leader, you would expect us to look at it and assess it. But again, I would assess it through the lens that I just described to you. Yeah.
Cool. Well, we have run over a little bit, so I'm just going to go with the last question. Apologies for that. But you brought the leverage target forward slightly of sub 3 times now expected during 2024 versus by the end of 2024 previously. Once this is met, are there any theoretical hurdles which could prevent the company from purchasing some of the Pfizer GSK holding, like we've seen recently with other companies in the sector, including JDP buying back some of the Mondelez overhang?
Yeah, look, I mean, I think the bigger step back from it, I mean, right now, I mean, we very clearly said our capital allocation priorities are invest in the business and delever. And then look at bolt-on M&A and then cash return to shareholders. Right now, given the leverage and the commitment to bring down the leverage, I don't have the full menu options available, right? So I can't press all the buttons on the piano yet, right? And I think the nice thing is there's a highly cash generative business that will not change. So I think over time, I think we're very quickly getting to a point where I can start using all the buttons on the piano and play. And I think I look forward to that. And that isn't in the too distant future, given the guidance we have, right? And I think, look, I mean, when you look across all the other staples, how they drive the total shareholder returns, share buybacks and dividends are part of that menu, and that's just these menu options aren't available to me yet. You've also seen maybe in the AGM notice, or maybe not yet, it just came out this week together with our annual report, is we're asking for share buyback authority, both a general one, which is pretty standard, but also from Pfizer and GSK. So if funds would be available, that we have the option to do that, which I think should give you, I think, a little bit more confidence that we're really thinking about shareholder returns in aggregate, of course, following those priorities that I just laid out.
Brilliant. Well, thank you ever so much. It's been a great discussion, and thank you to everyone that joined us as well on the line. And we look forward to catching up soon.
That's brilliant. Thanks, Victoria, and thanks everyone for your interest. Thank you.
Thank you. Bye-bye.